An order block trading strategy works for one reason. It shows you exactly where the smart money placed its orders. And that single edge is what separates a precise entry from a guess. Price does not move randomly. It accelerates away from the zones where institutions executed heavy buying or selling. In this video, you will learn 5 complete order block trading strategies built one on top of the other, from what an order block truly is and the 3 rules that make it valid, to the breaker block, the unicorn model, and finally, candle range theory. By the end, you will know how to trade these zones with precision, defined risk, and real confidence. So, if this kind of content helps you, take a second to like the video, subscribe, and turn on notifications so the next lessons reach you the moment they go live. And feel free to share in the comments which topics you would like us to explore in future videos. And if you want to support the channel on a deeper level, consider becoming a member to unlock exclusive content and help keep these lessons coming. You'll also find links to our trusted partners in the description below. Using them costs you nothing, and it directly helps the channel keep producing free educational content like this. To begin, let us clarify what an order block actually is. An order block represents a specific area on the chart where a large amount of capital entered the market, usually from big banks or major institutions, often referred to as smart money. Because these participants operate with significant size, their activity tends to produce strong and visible price movements. When price accelerates sharply away from a particular level, like in this example, it often signals that institutional orders were placed there. Moves of this magnitude require heavy buying or selling pressure, and the zone where those orders were executed is what we call an order block. In general, order blocks fall into 2 main categories. Bullish order blocks are created by aggressive buying activity, while bearish order blocks are created by strong selling pressure. In this video, bullish order blocks will be marked in blue and bearish order blocks in purple, although the specific colors are entirely up to personal preference. Once an order block has been clearly identified, it often becomes an area of interest because price has a tendency to revisit and react from that zone. It is common to see price return to the order block and then respond with a bounce or continuation. In this example, entering at the order block would have produced a favorable move, clearly illustrating how price can react around these areas. At this point, you might be wondering whether order blocks are the same thing as support and resistance. While both concepts are used to identify important price levels, they are not identical, and there are key differences between how they function and how they are defined. The first difference lies in how each one forms. Order blocks are identified based on strong and impulsive price movement away from a specific area. When price expands aggressively from a level, that area can be marked as an order block. Support and resistance, on the other hand, require visible reactions over time. If price rejects a level once and then rejects it again later, that repeated reaction allows us to define a support or resistance level. Another important distinction is the way these levels are drawn on the chart. Order blocks are usually marked as broader zones or areas, reflecting the range where orders were executed. Support and resistance levels are most often drawn as single lines. Even when they are drawn as zones, they tend to be much thinner and more precise compared to the wider zones used for order blocks. A third difference relates to how often price can interact with these levels. Order blocks are generally considered a one-time use. Once price returns to and touches an order block, it is no longer treated as valid. Support and resistance levels, in contrast, can be tested and respected multiple times before they lose their significance. Even though order blocks and support and resistance are different concepts, they can complement each other effectively. When an order block aligns with a support or resistance level, this creates what is known as confluence. Areas of confluence tend to carry more weight, as price has a higher probability of reacting when multiple factors point to the same zone. Before we can work with valid order blocks, we first need to understand how to correctly identify them. Earlier, we mentioned that strong price movement away from an area can point to an order block. However, it is important to clarify that this alone is not enough. A significant move by itself does not automatically confirm an order block. There are specific conditions that must be met for an order block to be considered valid. With that in mind, there are 3 key rules used to define a valid order block. These rules are essential because without them, it becomes very easy to mislabel random price movements as meaningful structures. The first rule focuses on the presence of a fair value gap. For price to qualify as an order block, it must create a fair value gap immediately afterward. This gap is often referred to as inefficiency or imbalance. Whenever you hear these terms, they are simply different ways of describing a fair value gap in price delivery. To make this clearer, let us look at an example. Here we have 2 price movements that appear very similar at first glance, as both move strongly to the upside. The difference becomes clear when we look closer. The example on the left shows a gap between the upper wick of the first candle and the lower wick of the third candle. In the example on the right, no such gap exists because the wicks overlap with the candle body. This gap is what defines inefficiency or imbalance. Even though both moves are strong, only the left example qualifies as a valid order block. To mark it, we take the candle just before the inefficiency and draw a rectangle covering the entire candle, from the highest wick to the lowest wick. The second rule is that an order block must remain unmitigated. In most cases, order blocks are considered a one-time use. Once price returns and touches the order block, even if it is only a wick, that order block is no longer considered valid and should not be reused. To illustrate this, imagine you identify a gap or inefficiency on the chart and decide to mark it as an order block. If price later returns and touches that zone, even if only with a wick, the order block is considered tested. Once tested, it is no longer valid and should not be treated as a fresh order block. Although there are approaches that reuse mitigated order blocks, those will be discussed in other videos. For now, the key idea to remember is that order blocks are generally treated as a one-time use. The third rule, and the most important one, is that a valid order block must lead to either a break of structure or a change of character after it forms. To apply this rule correctly, we first need to briefly revisit how market direction is defined. Because order blocks are validated by directional shifts in price, understanding whether the market is in an uptrend or a downtrend is essential. With that in mind, let's quickly review how market structure is used to determine direction. So, how do we actually determine whether a market is in an uptrend or a downtrend? Markets move through different phases. At times, price trends higher in an uptrend. At other times, it trends lower in a downtrend. And there are also periods of consolidation where price moves sideways and direction is less clear. In this video, we will focus specifically on trending conditions. Let us take an uptrend as an example. During an uptrend, the market does not move straight up. Instead, it moves in a structured way, forming what we call higher highs, usually marked on the chart as HH, and higher lows, usually marked as HL. They are called higher highs because each high is higher than the previous one, and higher lows because each low is also higher than the previous one. In contrast, during a downtrend, price forms lower highs, marked as LH, and lower lows, marked as LL. They are called lower highs because each high is lower than the previous one, and lower lows because each low is also lower than the previous one. In an uptrend structure, each time price breaks the previous high and creates a new higher high, this movement is referred to as a break of structure, commonly abbreviated as BOS. Of course, markets do not remain in an uptrend forever. At some point, the trend begins to change. This shift occurs when the previous lows are broken, leading to the formation of lower lows. Before this break, price was forming higher lows. Once those levels are broken, they turn into lower lows. This break of the previous lows during an uptrend is known as a change of character, often abbreviated as CHOCH. It is called a change of character because the market shifts from an uptrend structure to a downtrend structure, and the cycle continues. During a downtrend, price forms lower highs and lower lows. Each time a previous low is broken, that move is considered a break of structure, or BOS. Later, if price breaks the previous highs and forms higher highs during a downtrend, that move is again referred to as a change of character, or CHOCH. This is a brief overview of how break of structure, BOS, and change of character, CHOCH, work together to describe shifts in market direction. With that context established, we can now return to order blocks. For an order block to be considered valid, price must move with intention afterward, producing either a break of structure or a change of character. To see how this works in practice, let us look at an example. In this chart, price makes a strong move upward and leaves behind a gap or inefficiency, suggesting a potential order block. However, this alone is not enough to immediately draw the order block. We must first observe whether price produces a break of structure or a change of character afterward. At this stage, we can see that price has not yet broken the previous highs, meaning a break of structure has not occurred. Because of that, we wait and allow price to continue developing. Once price eventually breaks this high and creates a break of structure, that is the moment when we can draw the order block on the candle just before the inefficiency. In the next example, price again moves aggressively upward, creates inefficiency, and then follows through by breaking previous highs. Since this sequence results in a clear break of structure, it confirms another valid order block that can be drawn. Now let us examine a different scenario. In this chart, price is producing higher highs and higher lows, and we can identify a potential order block due to the presence of inefficiency. However, because price has not yet formed higher highs beyond the structure, this order block cannot be considered valid at this stage. After some time, price moves downward and creates another possible order block, this time on the bearish side. This is visible through the strong downward move combined with inefficiency on the red candle. Shortly after, price breaks the previous structural lows, forming lower lows. Since this happens during an uptrend, it qualifies as a change of character, confirming that market structure has shifted into a downtrend. At this point, our focus shifts to the most recent order block that aligns with the new trend, which is the bearish order block. The earlier bullish order block is invalid because higher highs were never formed, while the bearish order block is valid due to the confirmed change of character. In this next example, we once again observe a strong upward move accompanied by inefficiency, suggesting a potential order block. However, without a confirmed break of structure, this order block remains invalid. At this point, there is an important detail that can help improve how you use order blocks within your execution and overall framework. If we draw a Fibonacci retracement on this move, we can see that price reacts strongly within the optimal trading zone, which lies between the 0.618 and 0.786 retracement levels. If you are using the OTE concept and did not enter the trade when price initially retraced into this zone, you may still anticipate a potential reaction at this order block. Even though this order block remains technically invalid because structure has not yet been broken, it shows strong signs of behaving like a valid order block. In this scenario, if you had entered a long position in either of these situations, the trade would have resulted in a profitable outcome. Later on, we can see the formation of another order block, followed by an imbalance, forming within the OTE retracement zone. This sequence creates another high-quality area that can also serve as an excellent opportunity for a long entry. But here is the question that unlocks our next strategy. What happens when one of those order blocks fails? Because when a valid order block breaks instead of holding, it does not simply disappear. It flips its role and becomes one of the most powerful zones in smart money trading. That is the foundation of our next setup, the unicorn. So what is the ICT Unicorn strategy? The ICT Unicorn is a trade entry strategy from ICT that focuses on high-quality setups formed by the overlap of a breaker block and an unmitigated fair value gap. This overlap marks areas where market structure fails and institutional imbalance creates strong price reactions. The concept is straightforward. A failed order block turns into a breaker block while a fair value gap forms in the same zone. When these align, they create a high confluence area where price often retraces before continuing or reversing with precision. The strategy is based on three core elements: market structure, breaker blocks, and fair value gaps. Together, they explain how liquidity events and failed overflow lead to repeatable high-probability trade entries. Let us start with the breaker block. A breaker block forms when a valid order block fails and flips into a new supply or demand zone on the chart. In basic price action, we already know this behavior well. When price breaks through support, that same level often acts as resistance later, simply because of how traders react to it. The same principle applies to order blocks. An order block can fail due to a shift in market structure, an overextended price, or price tapping into an important higher time frame level. When a demand order block fails to hold and price breaks through it, that area flips into supply. This flipped zone is what we call a breaker block, and it becomes an area where we expect price to react and reject. Now let us talk about fair value gaps. Fair value gaps are also treated as supply or demand zones because they represent imbalance in the market. When a bearish fair value gap appears, it shows that selling pressure has clearly outweighed buying pressure, often driven by institutional activity. This creates market inefficiency, and price usually returns to that area to rebalance. When price revisits the fair value gap and there are still unfilled orders inside the zone, it creates an opportunity to trade in the direction of the existing momentum. That is when we often see price reject from the fair value gap and continue moving with strength in the same direction. It is important to keep one thing in mind. Fair value gaps must be unmitigated to remain valid. When a breaker block overlaps with an unmitigated fair value gap, this alignment creates a high-quality trading zone. When price returns to this area, the probability increases that it will behave as a strong supply zone and push price lower. In this situation, the entry is taken at the start of the zone, the stop loss is placed above it, and targets are set at the next key area ahead of price. The same logic applies in bullish scenarios, just in the opposite direction. Now let us look at a practical example using the euro-dollar on the 5-minute chart. We focus on the top of a recent impulsive move where a fair value gap has formed. The candle that created this gap can also be seen as an order block, marking a demand zone that would normally support price and push it higher. If price retraces into this zone, the expectation is usually a bullish rejection and continuation. But when price returns and breaks through the zone without holding, that demand area fails and flips its role. At that point, it becomes a breaker block. The bearish move that breaks below this former demand zone also creates a bearish fair value gap, signaling strong downside momentum. On their own, both the breaker block and the bearish fair value gap are meaningful areas. But when these two zones overlap, they create a high confluence trading zone. This overlap significantly increases the importance of the level and makes it a key area to watch for a strong market reaction. High confluence areas are zones where multiple price action signals come together, which naturally makes them more reliable. When different concepts align in the same area, more traders pay attention to that level. Because of this shared focus, these zones often trigger stronger and cleaner market reactions. That is why they become key areas where traders prepare, anticipate, and execute their trades. For the entry, the approach is straightforward. Place your sell limit order at the beginning of the high confluence zone and position your stop loss above the zone to protect against unexpected moves. When defining targets, aim for a healthy risk-to-reward ratio, such as 1:2 or 1:3, always based on the next important market structure levels ahead of price. To manage the trade more efficiently, one simple technique is to reduce risk once price reaches a 1-to-1 target. At that point, you can close half of the position and move the stop loss to break even. This way, even if price reverses and hits your stop, the trade does not result in a loss. At the same time, the remaining position is free to run in profit, allowing you to stay calm and focused while the market does the work. Another way to approach the entry is by waiting for price to return to the trading zone and then watching how it reacts. Instead of placing a limit order, you wait for a clear candlestick rejection, such as a long wick showing strong rejection from the zone. This method is especially useful when the trading area is wide, as it allows you to refine the entry and achieve a better price. In this case, the stop loss is placed beyond the trading zone, and the same exit rules apply. By using both approaches, you create a balance between confirmation and reward, which helps you trade with more confidence. Now let us shift to a gold example on the 15-minute chart. The market is in a clear downtrend, and the most recent impulsive move has produced a well-defined fair value gap, signaling strong bearish momentum. Inside this retracement area, we can identify an order block that offers a potential entry zone for sellers. If price holds below this area, the bearish bias remains intact. However, if price breaks above it, that behavior can signal a shift in direction and the possibility of a reversal. Pay close attention to how price forms an overlapping fair value gap and breaker block in this area. This overlap creates a high confluence zone, which is exactly where we look for high probability reversal trades. The plan is simple. Enter at the start of the confluence zone. Place the stop loss just beyond it to protect against unexpected moves, and target the next key market structure levels ahead of price, always aiming for a favorable risk to reward ratio. This setup allows us to trade with more confidence because it is based on alignment, not guesswork. When multiple price action signals point to the same area, accuracy naturally improves. By following this structure, we increase the probability of catching quality reversal trades while keeping risk clearly defined and controlled. Since this entry can be part of a reversal strategy, it is important to highlight the role of multiple time frame analysis. Better results come from combining lower time frame entries with higher time frame context. This includes top-down analysis, understanding the broader market trend, and marking key supply and demand zones on higher time frames before looking for entries. For example, in the gold scenario, imagine price has reached a higher time frame demand zone. If the unicorn model forms inside this area, it creates strong confirmation. The higher time frame context supports the trade, while the lower time frame provides precision for execution. Even if the lower time frame shows short-term bearish momentum, the higher time frame structure may still be bullish. In that case, a long entry aligns with the dominant trend, which greatly increases the probability of reaching the intended targets. So far, every strategy has been built around zones: the order block, the breaker, the fair value gap. Our final approach looks at the market from a completely different angle. Instead of zones, it focuses on liquidity and on how a single candle defines where that liquidity sits. This is candle range theory. So traders, what exactly is candle range theory? Candle range theory, or CRT, is a trading concept built around a simple idea. Every single candlestick represents a complete trading range defined by its high and its low. When you break that candle down into lower time frames, you will notice that its high and low often act as turning points. That is not random. Those levels mark where liquidity forms. In practice, those turning points become key liquidity levels because they represent the highest and lowest price traded during that period. That period could be a day, a week, or even a 1-minute candle. In other words, CRT is not about predicting random reversals. It is about understanding how price reacts to clearly defined liquidity boundaries inside a single candle. With that foundation, we can combine this structure with smart money concepts to build high probability opportunities. Now, in its classic form, CRT works with 3 candles, and each one has a specific role. The first candle defines the range. The second candle creates the sweep. The third candle provides the entry. Let's break that down step by step. Starting with the first candle, its high and low act as the primary liquidity levels that future price will often target. Since those levels represent the extremes of that trading period, they naturally attract orders and stop placements. For example, in a daily candle, the high and the low represent the absolute highest and lowest prices traded that day. That alone shows how significant those levels are. Even without analyzing lower time frames, we can identify important liquidity areas just by observing a single candle. The upper boundary is called the candle range high, or CRH. In smart money terms, the liquidity resting above this level is known as buy-side liquidity, or BSL, because it contains stop losses from short sellers and breakout buy orders. The lower boundary is called the candle range low, or CRL. In the same way, the liquidity resting below this level is referred to as sell-side liquidity, or SSL, since it includes stop losses from long positions and sell stop orders. This concept can be applied to any candle on any time frame. What matters is how price reacts to those boundaries. Now, when the second candle moves above the CRH and then quickly returns inside the range, that movement is called a liquidity sweep. In many cases, once liquidity is taken on one side, price will rotate toward the opposite side of the range. The same logic applies in reverse. If price sweeps below the CRL and closes back inside the range, it often seeks the liquidity resting near the candle range high. However, there is an important condition. If the second candle closes decisively above the CRH, the CRT setup becomes invalid. In that scenario, the market is expanding, not rejecting the range. But when the second candle fails to close above the candle range high and instead returns inside the range, we can then look to the third candle for a potential short setup, with the candle range low serving as the logical objective. That covers the core idea and the reasoning behind candle range theory. Now let's move to the concrete rules and break down how to trade it step by step on the chart. Now the first question to ask is, which candle should you choose when applying the candle range theory? If you've explored this concept before, you've probably seen that one of the most common methods among traders is to focus on the 1-hour candle formed right before the New York session opens. Why? Because the New York session often produces strong reversals, especially shortly after the open. It typically begins by sweeping liquidity built up during the London session and then shifting direction. This behavior creates excellent trading opportunities. So here's a smart and structured approach. Apply the CRT model to the 1-hour candle immediately before the New York open. If price sweeps liquidity outside that candle's range and then re-enters it, you're seeing a setup that aligns with both CRT principles and the natural characteristics of the New York session. This confluence often produces high probability setups, provided you time your entries accurately and manage risk properly. However, there's one limitation to this approach. It usually means trading against the prevailing trend. Trading in the direction of the trend gives more confidence and consistency in high probability setups. So, is it possible to use CRT while staying aligned with the trend? The answer is yes. There's a refined version of this model that applies CRT logic within trending conditions. Let's break it down. First, identify a market that's clearly trending up or down. Then, wait for a corrective move, because corrections provide both better entry prices and safer stop-loss placement. For example, if the last impulsive move started from this point and pushed all the way up to here, we expect the correction to unfold within this range. From that point, we apply the CRT model only to bearish candles. Since the overall trend is bullish, we mark the high and low of each bearish candle and observe how the next candle reacts. If the next candle breaks below and closes outside the range, the setup becomes invalid and we move on. Then, we repeat the process with the next bearish candle. This continues until we find a candle that sweeps below its low but closes back inside its range. That's when we have a valid CRT setup. At that point, we've identified both the range and the sweep. Now, the next question is, where exactly do we enter the trade? A simple approach is to open a buy position immediately after the sweep candle closes. But there's a more refined and higher precision method. We can zoom into a lower time frame to locate a more accurate entry point. For example, if we're analyzing the 1-hour chart, we can drop down to the 5-minute or 15-minute chart to see what's really happening inside that move. On the lower time frame, more structural details become visible. In this strategy, we use the fair value gaps that appear right after the sweep as our entry zones. All we need to do is wait for a fair value gap to form following the sweep and then place a buy order within that zone. Our stop loss goes just below the gap. For trade management, we can make the position risk-free by taking partial profits when the trade reaches a 1-to-1 risk-to-reward ratio. This way, even if the market later reverses and hits the stop loss, we keep our capital protected. For the remaining portion, we let profits run until price reaches a major structure level ahead. Since this is a trend continuation setup, this combination of CRT logic and fair value gap entries offers a smart and efficient way to trade candle range theory. So, trader, if this video brought you more clarity, like it, subscribe, and turn on notifications so the next lessons reach you. And tell me in the comments what you want me to cover next. And if you want to go deeper, you can become a member of the ComLucro trader community right here on YouTube. It unlocks exclusive content, early access, and extra tools for your development, while directly supporting the channel. You'll also find our trusted partners linked in the description. Using those links costs you nothing and helps us keep producing this kind of educational content. And remember, the mission of the ComLucro channel is simple. We help traders build clarity, confidence, and structure, so every decision is made with discipline and intention. Here you'll find complete courses built as a true trading masterclass. Liquidity, market structure, higher time frame analysis, and supply and demand. Always focused on reading price and executing with a professional mindset. We also cover trading psychology, risk management, and long-term consistency. Because trading isn't just about charts. It's about mindset, discipline, and execution over time. Our main courses include smart money concepts, ICT, technical analysis, trading psychology, and Wyckoff. Alongside that, we share insights from respected traders whose work helps you understand how markets really behave. Thanks for watching, and I'll see you in the next video.